Hi, good afternoon. Welcome to the marketplace. Coming up, total revenue from oil sector declined significantly to $769 million for last year. Also coming up, rising risk margins limit impact of policy rate cuts on lending rates. Ahead, we discuss how to reduce the margins and improve the transmission of policy rate cuts to borrowers. My name is Darryl Kwao. Details coming up. Thanks for staying with us, everyone. First up, Ghana's total revenue from crude oil exploration and exports has dropped significantly, reaching $769 million at the end of 2025, according to government data. Details in the following report.
In 2024, the total receipts from oil-related activities in Ghana reached $1.63 billion. Now, fast forward to the end of December last year, and the amount stood at $769 million. The development can be linked to challenges in Ghana's oil sector in terms of declining production and challenges with prices of crude oil on the international market, which impacted on Ghana's revenue. For some, if this trend should continue this year, that might not be good for government when it comes to revenue mobilization. Let's focus on the 2025 performance. Well, the report showed that despite the not-so-good numbers, corporate tax brought in some $346 million, compared to that of more than $500 million that we had in 2024. For last year, $863 million was paid by the oil exploration firms as surface rental. In terms of monies realized from crude oil savings, it stood at $1.5 billion. A careful look at the numbers over the past 3 years showed that what we recorded in terms of revenue for last year was the lowest compared to 2024 and 2023.
Benjamin Nsia is Executive Director of the Center for Environmental Management and Sustainable Energy. He joins me on Zoom to discuss this. We're just going to focus, Benjamin, on the second half of 2025 based on data released by the Bank of Ghana. So we understand oil receipts in the second half dropped sharply compared to 2024. What caused this, do you think?
Output has declined. Comparing these two periods, that's second half of 2024 and also the second half of 2025, as well as price of the product on the international market. If you look at our 2025 budget with our 5-year moving average, we're expecting to sell this product at around $74 per barrel, but the outturn was $60 per barrel, and that means that even if production or output was constant, revenue was going to slash or was going to plummet, and that is why in the second half of 2025 we saw revenue plummeting both on output and also both on price.
Yeah, and so revenue from the Jubilee and Sankofa fields also fell. How worrying is this for Ghana's oil income?
Most of these wells are becoming maturing wells, so output will continue to decline until we begin to develop them or begin to engage in more operational activities to explore other areas of improving output, because these wells have been in existence for the last decade, and for that matter output is also declining. And I think that we need more investment in areas of exploration and also areas of expanding some of these wells or doing some developmental activities so that we can increase output. If we are able to increase output, I think that revenue will continue to slide or continue to plummet.
So based on the report, we understand that the Petroleum Holding Fund received about $400 million, that is, and paid out $490 million US dollars. How sustainable is this?
Its sustainability depends on inflows from oil proceeds as well as good decision making in terms of our investment of some of the proceeds from this oil output. If we're able to invest in better securities or better government coupons, I think that at the end of the day, those interests will plow back into the PHF. If we're unable to do that, it will continue to harm us. The other side also has to do with output, as I indicated. If the output continues to decline and prices are not favorable, the Petroleum Holding Fund will continue to decline, will continue to decrease. Fortunately, if you look at the second half of 2025, even though the proceeds from oil as well as the other income, which are not directly linked to our liftings, were quite lower compared to the actual lodgement into the fund, because we got about $399 million, but actual allotment or lodgement was around $423 million. So it means that certain investment activities done by the Bank of Ghana as well as other sector players inure to our benefit by increasing our PHF. If we hadn't taken that decision, our PHF will also be on a downward trend, and that is also going to ensure that there's no sustainability in terms of managing our risk factors in future.
All right. Corporate tax and interest added over $200 million to the fund. How important is this in supporting Ghana's oil revenue?
Within the fiscal regime, I think we have one of the highest CITs in petroleum upstream, 35%. And if our players, including those who are engaged in the main operational activities of exploring and developing wells or producing oil, as well as others engaged in other surface activities or what they call support services, at the end of the day, if they're able to do well in terms of realizing profitability, it means that Ghana also earns from the CIT. So what there's the increment in CIT, or that huge CIT figure, which is higher than our lifting, indicates that most of the upstream players are doing quite well, and in their activities, doing quite well means that Ghana is attaining higher profitability from the sector. And we must also ensure that we put on certain measures or interventions to block any loophole that will not let us as a country realize all these potential revenue sources to beef up our Petroleum Holding Fund.
So with crude oil earnings down, what should the government do to protect petroleum funds and the stability of the sector?
I think the law is very categorical on it in terms of what goes into the fund, and also which areas we need to invest to ensure that Ghana attains full benefits from our petroleum revenue. In terms of stabilization, in terms of heritage fund, these are clarity based on law, and I think that we should continue to invest our
All right, Piers, we lost a few seconds of your submission over there. If you could just kindly recap.
Yeah, so as I was saying, I think that we need to continue to invest in those legal institutions that have been established by the PRMA, and also continue to maybe ensure that there are certain incentives that boost production. If you're able to do these two things, I think that the Petroleum Holding Fund will be safer within the medium and long term.
All right, Benjamin Nsia, Executive Director of the Center for Environmental Management and Sustainable Energy. I appreciate your time here on the Marketplace. We are taking a short break. When we come back, we are going to be talking borrowing costs. Don't go anywhere. Welcome back to the Marketplace. Time for the exchange. And in 2025, Ghana recorded notable improvements in key macroeconomic indicators, with interest rates, inflation, and exchange rate pressures all easing over the year. But a closer look at the data reveals a critical concern. Despite sharp cuts in the Bank of Ghana's policy rate, borrowing costs did not fall by the same margin. This afternoon on the exchange, we want to examine how rising risk margins in the banking sector are weakening the impact of monetary policy on lending rates. Dennis Brown, Associate Director in the Strategy and Transactions team of Deloitte West Africa, joins me. He's written on that and he's going to shed more light on it. A great writer, by the way, Benjamin. Dennis, sorry. So the Bank of Ghana data for 2025 shows a steady decline in key interest rates and overall improvement in macroeconomic indicators. Yet, as you write, borrowing costs for businesses and households remain high. Can you explain why the positive impact of policy rate cuts hasn't fully translated into lower lending rates?
All right. Thank you very much, Daryl, and thank you to your viewers and listeners as well. I think that as the article puts it, the big policy cuts that we have seen is what drove me to the data. I wanted to look at how the average lending rate has trended with the monetary policy rate. And I did find out that, yes, whilst it's trended down positively, it could have gone down very much. Whilst it has trended positively, it could have gone down, by a higher margin than it did. So, with my knowledge as what constitutes the average lending rate, which is basically a combination of the Ghana reference rate and is a combination of the Ghana reference rate and risk margins that are built into the price by lenders. I quickly did the differentials and could really see that no, the risk margins are increasing over time at the same time that the monetary policy rate and the Ghana reference rate is also dropping. So clearly, the discretion that banks and lenders have to build an additional margin into the lending rate is either being abused or perhaps there are genuine concerns in the market relating to risk that is then being built into the price. And this has, sort of held up the borrowing cost a bit more than it could have, looking at the rate of cuts that we've seen in the monetary policy rate as well as the Ghana reference rate.
So your analysis highlights widening risk margins as a key factor constraining the pass-through of the monetary policy rate. What exactly are these risk margins and why have they increased so significantly in 2025?
Yes, one of the things we highlighted is that it's very important that Bank of Ghana, where a huge institution they are with all the structures, should look into this further. First, it requires some investigation, working with the banks and other lenders to identify where the risk factors are or what causes these, risk factors, and to see how best we can use a combination of policy and regulations to mitigate that. But on my own, I identify a few things based on general knowledge of what constitutes risk margins or considerations by lenders for risk margins, and I listed a few of them there. One of them relating to credit risk, where there is a sense that we are in a tough environment. The banks thought of it that we are in a tough environment, or we've seen significant improvement in the macroeconomic environment, but if they are running into bad loan books, they think that environment is still high risk, they are going to price that in there. And so what we are asking for Bank of Ghana to do is to work with these banks to ensure one, prudent and strict implementation of their own credit risk management, as well as to see whether there are excesses that can be standardized, because that then gives maybe too much room for banks to operate in and to abuse their discretion. We also talked about project risk, where there are specific projects that banks may assess at high risk because of the risks attached to the cash flow. And that we think typically comes from not structuring the project well, where you don't get the cash flow profile, structured properly. And this can stem from you not working with experts like financial consultants that would see through the lines and help you structure the projects well. You are likely to end up in a situation where banks want to do the deal, but they see the risks, and so they have to price it into the margin. There are other things around loan security and collateral where documentation has been an issue. Look at our land administration system, for instance. It's very difficult to register properties, even those that genuinely belong to you. So where there are these deficiencies in terms of documentation, banks that see the opportunity may still want to go ahead, but it will come at a higher cost, which is built into the risk margins. Then the general market conditions, we've seen significant improvement, and so would have expected that this would follow in terms of how the risk margins drop, but that's not what we are seeing. And so it tells us that either the banks are, abusing their discretion over the risk margins, or there are genuine concerns in the market that Bank of Ghana can work with the fiscal authorities to address. We also have other factors around industry, specific risks like oil and gas. Some of the risk weightings that Bank of Ghana will assign some of the projects there because of that industry will be high, and the banks will run along with that. And so what we are saying is that some of it could relate to structuring of the industry itself. We have an industry that is capital intensive, and so we have a lot of the funding coming from foreign sources, and so the inflows are routed directly to foreign banks. And we've been on platforms where the banks have complained that, well, if you're not retaining a significant amount of the inflows, then it reduces the confidence with which we approach such projects, because we also want to see the cash inflow retained here so we can leverage same to repay loans in that sector if we give out loans in that sector. So those are some of the things that Bank of Ghana can deal with, including regulatory requirements, how they can look at some of the regulations that are overly stringent and can be relaxed. Where we have to do with industry specific risks and specific regulations from Bank of Ghana, which has the banks obeying certain rules. We have indicated that yes, Bank of Ghana can investigate, but to be able to achieve maybe a relaxed rule that can work for everybody, that will require investment in systems and structures that will allow for effective and tailored risk management and monitoring, as well as timely response to risk incidents. Once you have these systems in place, it gives confidence that the risk will be tracked earlier on and the response will be swift and adequate, and therefore from the onset we can work with reasonable margins rather than pricing in higher than expected margins. We also talked about profiteering from banks. It's not impossible that banks may see the opportunity, and where competition is not that tight, they may abuse the discretion they have to build in higher than expected risk margins. These are things that Bank of Ghana can look at, investigate further, work with other fiscal authorities to implement measures to address.
Well, given that the monetary policy rate was cut by 900 basis points last year, but lending rates fell more slowly, how does this affect the effectiveness of monetary policy in Ghana? I know you talk about some of the things the central bank can do, but are there limits to what the central bank can achieve through rate adjustments alone?
I mean, we know that in between the monetary policy rate and the final lending rate, there are other factors that also play out. And that is why you are never likely going to see a one-to-one mapping. So the monetary policy rate goes down by 900 basis points. You cannot expect the lending rate to also go down by 900 basis points. No, because there are other factors that play out there. But what we are saying is that we look at the risk margin that banks using their discretion are pricing into loan deals. And that alone, if you hold other things constant, are slashing the potential full impact, which is the 900 basis points that the monetary policy rate could have had on the lending rate by half, almost half. I think about my calculations was about 420 basis points is the how much the risk margin has increased over time. And so if Bank of Ghana can work with the the banks, the fiscal authorities that manages fiscal policies, Ministry of Finance, etc. They'll be able to address some of these factors that I have laid out. But like I said, it will always require investigation first to ensure that yes, indeed, these are the factors that are playing out, and to then address them. So yes, it is constricting the impact of monetary policy rate significantly. Whilst we do not expect for a full pass-through effect, we believe that the pass-through effect can be to a greater extent than we have seen, and that therefore can lead to a higher decrease in borrowing cost, which will be good for us here.
And what factors could be credit risk, project risk, regulatory requirements, or lender practices driving these higher risk margins, and which ones do you see as the most critical to address?
Yeah, I think that all of them are critical. Maybe where we see low-hanging fruit is profiteering lenders. So because there's some discretion around your assessment of borrowers and the margins that you price into loan deals. That is an area where, banks or lenders can, abuse just for purposes of profiteering. But we have indicated that that can be addressed through competition, because if a borrower has, access to, various options, maybe 5 banks that want to give the loan, they are in a good position, in a strong bargaining position to, bid down the risk margin. So that we think policy and regulations can help address that as low-hanging fruit. But there are some of the things that are also structured, like Bank of Ghana has a rule or risk weightings for various types of projects, which with the right investments, we believe they can relax those rules. But the right investments would have to precede that. You invest in the systems that effectively monitor and timelessly respond to risk incidents. Then you can lower the risk margin, because the probability that that risk will have the anticipated impact can then reduce significantly.
So based on your analysis, what steps should the Bank of Ghana and other fiscal institutions take to reduce risk margins and improve the transmission of policy rate cuts to borrowers, and how could this impact lending rates and overall growth of the economy?
Yeah, it's one simple thing, though. I think that's policy coordination. And 2025, we've seen a good amount of that. And I think the Bank of Ghana governor has indicated severally in some of the press conferences that they have ensured that there is proper policy coordination between the Bank of Ghana and the Ministry of Finance and other fiscal authorities, so that they are all moving towards the same objective, although they have different and distinct roles, right? That has to be improved further, and that I believe is what can result in a significant reduction in these risk margins. Because all these factors, as we listed them, for most of them, we have indicated Bank of Ghana to work with other fiscal authorities. Of course, for some of them they would have to rope in the banks, the lenders themselves, because you still want to retain some discretion at that level to encourage competition. We run a free market system, so you can't just say everybody should give out loans at the Ghana reference rate. Every one of them will look at their own assessment of the project in front of them and pricing the risk. But we also don't want a situation where they have such a huge margin of discretion that they can abuse it. And it's important that that is guided as well. The impact on that, if they can achieve it, will be to significantly reduce borrowing costs. And when borrowing costs is reduced, overall cost of capital goes down. It will improve access. Businesses and investors will, find capital cheaper, and then we invest in the high growth segments of the economy, expand the economy, create more jobs, going forward.
All right. Thank you so much, Associate Director, Deloitte West Africa, Dennis Brown. I appreciate your time. Actually, the Ghana reference rate for February 2026 is expected to ease marginally to 14.58%. This projection is based on our calculation using the established industry formula. Here's more.
The Ghana reference rate, a key benchmark for setting of interest rates by commercial banks, and it stood at 15.68% for the month of January 2026. However, based on our own calculations, the rate should go down to 14.58%. Now, we arrived at this final figure based on the formula used in calculating the reference rate. That is, take the monetary policy rate of 15.5%, the interbank rate of about 14.19%, and the Treasury bills rate of 11.19%, expressed in the formula given. That should let us arrive at this rate of 14.58%. Based on the established formula, it is clear that the monetary policy rate accounted for the highest weighting in the basket when it comes to calculating this reference rate. If the commercial banks don't apply any extra charge, then we could see the reference rate be announced on Wednesday at a rate of 14.58%. It actually represents about 1.1% cut in the reference rate from the month of January 2026. This should go a long way to impact on fresh loans, as commercial banks are expected to reduce their interest rates, and also for persons that negotiated their loans at a variable rate. However, individuals that negotiated their loans with the commercial banks at a fixed rate may not witness any change or review when it comes to the cost of servicing their loans when this Ghana reference rate is announced tomorrow.
All right, by Wednesday we'd know, right? More news on our website, myjournline.com/business, including Ghana earning less money from oil exports in the second half of 2025. That's according to the BOG. myjournline.com/business. We leave you with the latest international headlines.